One of the easiest ways to get wrecked in financial markets is to buy an asset for the wrong reasons. It's not because you're going to definitely lose money. You might end up making a lot of money. However, markets go through tough times. And it's during these tough times you might get confused. You might not know what to do and you might end up selling for the wrong reasons as well. In this video, let's look at some terrible reasons to buy an asset. Hopefully you can learn something and avoid them at all costs. Let's begin. Before we begin, a quick reminder, nothing in this video is financial advice, and if you're buying into any asset, make sure you do your own research. Anyway, let's start with reason number one. You're buying a stock just because the stock price has dropped significantly. You should never buy a stock or an asset just because the price has fallen sharply. You need to really understand why this is happening. You need to do some research and understand the underlying reasons for this decline, or the company's fundamentals might have changed. When a stock price is dropping, there are several key reasons that you might want to consider. Let's look at some of them and let's look at some examples of them at the same time. Firstly, a low stock price doesn't automatically make it a good value or bargain. There are plenty of examples of this happening. A stock can drop 70% and still be overvalued at that point. The price may also drop due to serious problems with the company's business model, finances, or management. This is something that we recently saw with SMCI. There's something known as catching a falling knife, and this is something that you should absolutely avoid. This is something that we saw with PayPal after 2021. Overall, instead of focusing on price alone, look at companies' financials, competitive position, and growth prospects. You have to create a very holistic thesis of why you want to invest in something. Overall, just remind yourself all the time, price isn't everything. The price may drop 70%, but you still need to do your research before you buy the asset. The next reason, which is quite common actually, is a terrible reason to buy into any asset, and that is you got a hot tip from someone. It's always a terrible move to buy a stock or an asset just because you got a tip from a friend, family, co-worker, or even a stock market analyst. You need to still do your research before you buy into something. This is very prevalent, especially during bull markets. Everybody is buying into something and is telling you to buy the same thing, and you need to be very careful during those times. We are actually going through that period even now. Here are some key tips that you should always remind yourself. Even well-intentioned stock tips are often based on rumors, speculation, and limited information. Most people don't know what they're talking about and there's plenty data backing it. Then the person giving you tip likely doesn't know your financial situation or risk tolerance, so you need to do that for yourself. Also, pump and dump schemes are often hidden as hot tips to lure unsuspecting investors. This was very evident during the SPAC craze of 2020 and 2021. Overall, just remind yourself, if a stock tip seems too good to be true, it probably is. There are no guaranteed sure things in investing or in life. Anybody who was investing in 2021 knows exactly how this goes. You'll hear something from a friend, you'll get FOMO, and you'll want to buy that asset as well. Try to avoid that at all costs. By the way, if you're enjoying the video so far, hit like and consider subscribing. And tell me in the comments, how many of these mistakes have you made? Talking about emotions brings us to the next point, and that is you're buying an asset because you have got a gut feeling about a company or an asset. Sometimes you rely on hot tips from other people. However, sometimes you can rely on your own feelings to make a decision. You have a gut feeling about a stock or a company and you feel like investing in it. You don't exactly know why you're doing it. However, you end up buying it anyway. That's a terrible reason to invest. If you're investing purely based on emotions or feelings, that's not investing. That's purely gambling at that point. Your gut feeling might actually be influenced by several investing biases that exist, such as confirmation bias, where you seek out information that confirms your existing views, or recency bias, where you're overweighting recent events too much. Remember, hunches and intuition aren't substitutes for fundamental analysis of a company's financial health, competitive advantages, and risks. We saw this a lot during the 2021 market cycle, where a lot of investors had a gut feeling about crypto and meme stocks, driven by online hype and fear of missing out. They invested without understanding the underlying assets and many got burnt when prices crashed. Overall, your feelings might be right about something, but please base it on facts and data and not just emotions. The next one is something that I absolutely hate, and that is you're buying a stock because it is in the news a lot. Often when we start seeing something a lot in mainstream media, we just assume that it might be a good investment. Remember, popularity doesn't mean it's a good investment. It just means that mainstream media is getting the views based on that right now. I've actually made full videos about how mainstream media can wreck investors. Feel free to check those out. It often happens that by the time a stock is making headlines, it is often too late to buy. The price may already reflect the good news. Generally, media attention can be fleeting and doesn't necessarily reflect a company's long-term prospects. There are also some companies that actively seek media attention to pump their stock price, even if their fundamentals are weak. This one's actually quite hard to tell, but we have seen some examples of this. Remember, hype and buzz are terrible reasons to buy into anything. This is how investors buy high and sell low. We really don't want to fall for all the media bias, especially when it comes to investing, but it's there all the time and it's so hard to avoid it. But we have to do our best and stay away from it. The next reason is also quite closely related to this, but here we are not talking about mainstream media and we are talking about new media, that is social media. You're buying a stock or asset because you're blindly following crowd sentiment or social media. This one's becoming harder and harder to manage because of how many finfluencers are out there right now. When I started making videos, I had promised myself that I'm never going to make a video about a hype stock or an hype asset, and I'm trying my best not to do that. I don't get a lot of views because of that, but that's what's selling on social media right now. No matter which platform you go to, that's exactly what sells. I'm not saying it's a bad thing. There's a lot of good information floating out there, but it's also very hard to find it and actually understand which ones are good and which ones are bad. There are lots of really good analysts out there. In fact, I follow a lot of them very regularly. They do a great job, but it's actually very hard to find them and rely on them, and it takes a long time to actually find those people. Just make sure you take the time to understand who these people are before you start listening to them. But other than that, if you're listening to just the general sentiment of social media, that's a terrible reason to buy something. This is actually very hard to escape because more and more young people are relying on social media for their investing news. I'm pretty sure this is going to cross 50% very soon. We all know what happened in 2021. There was a meme stock frenzy surrounding GameStop and AMC and some other companies. This was fueled by social media hype on platforms like Reddit and Twitter. Many inexperienced investors bought these stocks at highly inflated prices, not realizing the risks involved. When the hype died down, those who bought at the peak were left with significant losses. And this was across the board when it came to meme stocks. Here are some key things you really need to understand. Social media can amplify hype, rumors, and misinformation about stocks, leading to irrational exuberance or fear among investors. Online forums and communities can create echo chambers where dissenting opinions are drowned out pretty quickly. This gives a false sense of consensus. Again, I want to say that social media can actually be a great source of information and ideas, but it does not replace your own due diligence. Nowadays, whenever I find something on social media, I make a note of it. I go back, do my own research, and understand if this fits my investment thesis. There's a lot of information out there, and there's a lot of shit out there too, so you have to be careful and understand what you're listening to. Now, the last reason I'm going to say is the most obvious one. You are buying into something because you want to get rich quick. Let's start with some wise words from Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. These are some words that should be part of everybody's investment thesis. You should not be buying into any stock or asset with the expectation of becoming rich quickly. You have to understand the long term impacts of buying something. You don't want to hold on to something which is not for the long term. If you're thinking short term, try trading. Do not mix investing and trading. Getting rich, especially in the stock market, is usually a slow and steady process and not an overnight phenomenon. This can often be skewed by overnight success stories that are always floating around. Chasing hot stocks or trying to time the market often leads to buying high and selling low. Stocks that seem to offer a shortcut to wealth are often too good to be true, and there's no free lunch in investing either. There are a lot of smart people in investing, and they are the ones who are making money off you if you do stupid stuff. Overall, a sound investment strategy involves diversification, patience, and a long term perspective, not a get rich quick mentality. So here's the deal. If you want some get rich quick stocks or assets, go for it, but do it with a very small portion of your portfolio. Again, do not mix your investments and your trading portfolio. It's not bad to aim for moonshots. You can do that. However, try to protect your capital. As Warren Buffett has famously said, the first rule of investing is to not lose money, and the second rule of investing is to go back to the first rule. Anyway, those were some of the reasons I wanted to cover in this video. These are some terrible reasons to be buying into any asset or stock. Please try to avoid it. There are also plenty of other reasons you should not be investing into an asset. However, these are the common ones. If you learn these properly, you're going to make much more informed and rational decisions in your investment journey, and you last a long time in the market. I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.